Okay, so good morning, everyone. Welcome to the macro snapshot. What are we today? We are November the 14th, Friday, last day of the week. So let's immediately have a look at the VIX chart here. You can see that volatility is actually spiked up quite aggressively. We're now over 22 on the cash kind of VIX, so to speak, the spot VIX, I should say. So that's implying a sort of a move of well over 1% per day. And why is that? That's just because the equities, we've seen quite a nasty sort of sell-off in the equities. So we see, just having a quick look through here. So you see that the ES continues to fall from yesterday. We see the Nasdaq also down more aggressively and breaking down through this sort of upwards channel here. So the next support for the Nasdaq is probably going to be at about 24,300 or so. That could possibly bounce. But we also see that the Russell is really underperforming here. It's actually broken down. So you see the Russell here is really the underperformer. So what we're starting to see here, and I just want to put a little bit here on some of the different sectors. Just give me a second here. I bring up the different sectors. And we can see here that there's real concern here about sort of valuations and whatnot. So you can see yesterday, this is not from today because obviously the market's not open yet, but you see from yesterday, you see here the technology XLK ETF down quite aggressively. Now just compare that to something like healthcare, which obviously is up, and then look at something like consumer discretionary, which was down big red candles yesterday, sort of really underperforming against something like consumer staples. Now, consumer staples well up, but of course, consumer staples coming off a lower base. And essentially, what the market is really trying to say here, let's just have a look at, just picked up some stuff here, sort of analysis of yesterday, and you can really see what's going on, just the concerns of the market. So you can see yesterday, there's the S&P 500 overall down about 1.7%. But as you can see, technology, consumer discretionary are down a lot. And whereas the sort of more of the safe havens, like the healthcare and your consumer staples actually doing much better. And even energy doing better. But energy was on a geopolitical thing, which we'll get to. And this is a lot of this is just about concerns, real concerns here about forward valuations and just the valuations of some of these companies, and also amount of the money they're spending on capex, on capital expenditure, and this sort of ratio between the amount of money they're spending. And yes, for companies like Meta, it will generate more income, but only a small proportion. I was reading some research yesterday, essentially that companies like Meta, they're spending 70, 80 billion a year, possibly to make another 5 or 6 or 7 billion a year. So just the mathematics is starting to get a little bit stretched, and the market is really starting to dig into some of these expectations. And you can see here, this is like a price to earning forward sort of estimates compared to the 20-year histories. And you can see the diamond is where we are now. And you can see something like information technology. This is one standard. The box is a standard deviation from the mean. So about 64% of the time. But you can see here that something like information technology, very, very stretched forward price to earnings. You can also see consumer discretionary pretty stretched. And then when you get down to these sectors, utilities, staples, materials, healthcare, financials, a lot less stretched. So it's interesting to see the S&P 500 itself is stretched out. And then just finally, you can see just yesterday the performance. And what we've got here is the return. So this is the break even yesterday, zero. And you can see the only one which actually was above was the energy. But again, this is a little bit what we just pointing out before is compared to the forward PE. The Z score, of course, is the sort of statistically adjusted standard deviation. And again, you can see that the fall here, 2.5%, 3%, 2%. It's all of these companies in the consumer discretionary and the technology and communication services, which really have these very, very stretched valuations. So maybe what the equity market is trying to do at the moment is just sort of bring back some of those valuations of the most stretched ones, and also the companies which are not the lower quality companies, because what we also saw yesterday is that value got a bit of a bid, and so that's why also you're seeing the Russell 2000 underperform. So and again, just a couple more charts. So you can see small cap equities underperformed. You can see just the ratio there. You can also see, for example, value outperformed growth yesterday. So all in all, what we're seeing is a spike in the we're seeing a spike in the volatility. And just having a look at that, we can have a look here and just see. I just want to have a look here at some VIX metrics or metrics of VIX. As I said a couple of days ago, remember we saw the move index pushing up, which is the volatility index for the bonds. And in general, as we saw from that chart I showed yesterday, the equities do not like when the bond volatility moves up. And so we can see here just some of these. This is the VIX itself in the bottom right left-hand corner. You see the VIX itself, the spot moving up. But I also just would like to look at the curve. And you can see here, this is like November to December VIX futures. And you can see here that we're above zero. So now into positive territory, which is a bad thing because, of course, as the VIX curve moves up into a backwardated state, so that means that the front futures contracts are more expensive than the ones further out. That's signaling shorter term panic. A healthier and sort of less panicky, like a calm situation is, of course, with contango, when the front end of the VIX curve is trading lower than the further out contracts. So that means the spot VIX and then VX1 and VX2 and VX3 are actually in a sort of upward sloping contango curve, which should be below zero. And you can see here, of course, what's happened. This is a 15-minute chart, so relatively short term, but you can see that going back to, let's say, yesterday morning, Thursday morning, you can see here how that the November to December contracts have inverted, and so November actually becoming more expensive than December, going above zero, which is indicating sort of short-term, don't want to say panic, but short-term volatility increasing. So let's keep an eye on that today. And part of this is also because what's happening at the Fed. And we had another bunch of speakers yesterday. And remember that on sort of Wednesday, we had 4 or 5 Fed speakers. A lot of them were expressing caution, saying, possibly a cut in December. We're going to be data dependent, still very concerned about inflation. And we had more of the same yesterday. We had another 4 or 5 speakers yesterday. And if you actually just look overall, what they did say was that, possibly some sort of softening in the labor market, but it's difficult to know with certitude because of the lack of data. But what they all sort of seemed to be insisting on was that they still were concerned about the inflation mandate. And what we can see here is that just to keep an eye on things, basically the market pricing, this is market pricing of the mixture of futures and OIS, according to from the CME data. And you can see here now we're essentially at 50-50. What I would say, and just again, if we compare it, I'd like to compare it, you look at 1 month ago, you can see here how it was almost at 100%. You can see it was almost 100% to cut. But what is interesting comparing to yesterday is that yesterday we were at 50%. We're now actually gone up a little bit to 55%. So basically, as the equity market is coming down, we can see, just going to put this back here, we can see that the bonds are getting a little bit of a bid. So again, just to put it on the daily here, you see the equity market on the ES coming down. And you can see that, finally in the last few hours, we are seeing some of the bonds just pick up a little bit of a bid here. So you can see that the 2-year picking up a bid, we go to the 5, then the 10, and even the 30 also picking up a bid. So a bit of a sort of a safe haven here. And we're starting to see a little bit as well, the equities cracking globally. Some of those high flyers, for example, over in Europe. Let's just have a look. You can see that Europe, the Euro Stock 600 down, but also you can see things like the Nikkei also starting to sort of pause a little bit, and even the Kospi over in Korea, which has been on a tear, just having a little bit of a pause. So we are seeing some of these highs just sort of coming down a little bit. If we look at Australia, you can see a big down on the Australian stock market as well. So global equity, not only in the US, but global equity also having a bit of a tumble. That's giving a bit of a push to the US treasuries. Going to have a quick sip of some tea. Not all bonds, though, are going up. So what we have been seeing, I just want to have a quick look here, look over at the British pound. So quite a lot of action here in the UK. And we know that in the UK, you can see here the pound falling a lot. It's come back a little bit in the last couple of hours, but falling a lot. And I also just want to put on I'm just going to put on the British 10-year, let's have a look at, what is that, GB10, I think it is. Yeah. So just look at the yield here. You can see here that the yield on the UK sort of bond, 10-year bond, has spiked up from 4.43 all the way up to 4.55. So a huge spike up in yields, 10, 15 basis points. It's subsequently come down a little bit, as I say, much like the pound has recovered. But basically, we have the Chancellor of the Exchequer, Reeves, who on November the 26th will present her budget. And there's been a lot of flip-flopping, and the bond vigilantes, which is to say those who don't like a lack of fiscal discipline, are really being very focused on the UK. And what caused this spike in the bonds and this fall in the British pound was the fact that there was rumours that the Chancellor of the Exchequer, Rachel Reeves, would not actually be increasing sort of taxes, so less fiscal sort of responsibility in a sense, and the UK market and the global market really doesn't like that. And so the question then is, why did this sort of fall back a little bit? Well, subsequent to those sort of earlier sort of rumours, there was also sort of a thought that one of the reasons she was thinking of not raising taxes was because the economic situation, she'd had some internal reports saying that the economic situation actually was a little bit stronger in the forecast. So maybe that was a sort of a slightly more positive justification for not increasing taxes, and it wasn't just a lack of fiscal discipline. But anyway, a lot of sort of volatility in the UK gilt market, in the UK bond market, which is feeding into the pound. So what we just have to understand is that any news or headlines essentially saying that the government there is going to be less fiscally responsible. What does that mean? Less tax rises, more spending, unfunded projects, all of that kind of stuff is not being well received by the UK bond market, and anything which is in that sort of camp is hitting the pound. And we can see a little bit, again, it's probably sort of come back a little bit, but always interesting to keep an eye on the euro versus the pound. And you can see here that the euro pushing higher, again, it's come back a little bit, but you can see that the euro continues to sort of have a positive upward slope compared to the British pound. I'm not sure if I have it, but interesting to see the pound against the Swiss franc. Probably not an attractive chart. Let's have a quick look. Just bear with me for a second. Great British pound against the Swiss franc. Let's have a quick look. Yeah, so you can see here also against the Swiss franc, the pound really just, trading very, very heavily. And the last 3 or 4 days, as we're getting rumors of unfunded sort of spending programs and a lack of fiscal responsibility in the UK, that's really sort of causing the pound to puke at this point a little bit against the Swiss franc. Now, talking about the Swiss franc, there are other factors there. The Swiss franc is actually showing some strength. And part of that is just because there's been a lot of negotiations. And I'll just bring up the USD Swiss franc here. You see the USD falling down to pretty critical levels against the Swiss franc here. This is actually a key level here. There might be a little bit of support, but if it goes through there, we could see further weakness. But so why is this happening? Because, as you know, Trump did impose his 39% tariffs on Switzerland. There's a lot of talk that almost there's a trade deal of 15% is the new tariff number. So a significant reduction from 39 to 15%, and that's a relief, obviously, for Swiss industry, for Swiss exporters, and whatnot. So that's giving a bit of strength overall to the Swiss franc. Now, talking about Trump and the tariffs, from what I'm reading and what the news reports are, there seems to be some concerns within the White House that maybe the cost of living crisis is really becoming a political liability. And we saw that the Democrats, in the elections last Tuesday, had a relatively strong showing. They, of course, won the new mayor of New York is a very left-leaning Democrat. And of course, some of the governorships went to the Democrats as well. So the point is that the political implications of a high cost of livings and the tariffs, there's some kind of talk that maybe Trump is trying to reduce tariffs against, for example, Switzerland, but also we're seeing in coffee, I think cocoa, chocolate, a few others I forgot this morning. But Trump is like starting to sort of idiosyncratically reduce here and there tariffs on various industries, on various products, just to maybe alleviate some of this cost of living crisis for average Americans. The famous K-shaped economy, and it's a real problem. And it's just interesting if we look at some of these things. I just wanted to have a look at how that's playing out. For example, if you look at coffee futures, the fact that again, this is just the coffee futures. You see that coffee future prices are falling, and that's having the intended effect. So just the fact that some of those elevated sort of tariffs on some of these basic everyday products are being reduced by the Trump administration. So the question really is that going to continue? Are we at the beginning of some gradual unwind or reduction of tariffs in general as a policy, because Trump, whatever else he may be, is a fairly sensitive politician, and he will understand that the cost of living crisis is becoming, as I said before, a political liability potentially, and maybe, idiosyncratically, from various products and industries, some of these tariffs will be reduced. So that's definitely something to keep an eye out on. Other commodities which popped was wheat, but also let's have a quick look at what's going on in oil. Let's just have a look here. Where's my oil chart? So basically, there were quite a few serious attacks by the Ukrainians using drones on Russian sort of refining capacity in Crimea. And so interesting that and this is some of these are the biggest export hubs for Russian oil, but also for wheat. So we saw a spike in the wheat in the price of wheat futures. But interesting here to look at oil, and I'm going to break this down on, let's say, so keep in mind this downward downward chart, downward sort of trend line here, this gray line. So we saw yesterday that popped up to there and basically was rejected. But again, we saw another pop. I'll put it on a 4-hour chart just to break it down in a little bit more detail. You can see here that on the news about the Ukrainian attacks on the oil refineries, that the price of oil kind of popped, or the futures here, the WTI popped, but it still could not breach this level. So you see that this downward level here, this downward trend line, is still becoming a problem, and oil falling back. So oil's still trading heavily. I mean, it's trying to push higher, even on geopolitical, sort of shocks like this, but just finding it difficult. And the longer it cannot penetrate above and break out above that downward trend line, you've got to think that oil could be sort of pushing to lows. So again, if we have a look at the spreads, let's look at December 25, December 26. Similar kind of situation here, that you see that, the front of the curve for immediate delivery, popped up a little bit, but much like the outright price, and the spot price kind of pushed back a little bit. So oil just finding it difficult to keep any upwards momentum, and that's keeping it lower. The other things which is just having a little bit of a pause, and I'll finish on this, is the precious metals. So particularly I want to have a look at silver. We'll have a quick look at gold, but you see here gold on the 4-hour chart. We'll put it back on the daily chart here, but you can see gold still a very, very powerful chart. Okay, so it got to this new level, broke out. We all understand that, and it got to the Fibonacci retracement here, about 61%. Then had a nice pop. But again, if you look at sort of the reverse fib, so what I've done here is put the Fibonacci from, let's say, about the 20th of October, you draw it here, and you sort of see. What I was saying yesterday is that the bulls, in order to remain in control, they have to decisively break above this Fibonacci. Otherwise, it could just be like a technical rebound. And so far it hasn't done that, and it's now rebound. It's now sort of falling. And again, just put it on a 4-hour chart. If we do that, not to overly complicate things, but if we now do another fib, we can sort of see really where the bulls have to absolutely. Whoops, sorry, got the wrong one here. Oh, I don't want that. Want the fib. So what we can do here is now take this sort of impulse. You can either sort of measure it from here or maybe from here. It doesn't really matter in a sense. The principle is essentially that, as you see here, from this recent impulse up, which was rejected, gold has now come back down. And really what the bulls need to do here, we're already breaching the 38%. This is the 50% at around about 4,089. And of course, the 61% at 4,054 on the front futures contract. You can see here that the bulls really, they need to pick it up quite soon. I would say in this zone. The bulls need to pick it up in this zone. If they can't do that, you've got to say that this was nothing more than a sort of a Fibonacci bounce, and that it's been rejected. And if we, I would say that if we break below, let's call it 4,050, we could see a little bit more weakness in gold. That's my personal humble opinion. Of course, if we get some kind of geopolitical risk or whatnot, but we have seen that the correlations between sort of risk off and gold have actually been coming down over the last few days. So that's an interesting one. And of course, let's have a look at silver. I'm going to look at the spot silver here, and you can see because the spot silver, just to keep in mind, if you see here that on the futures, it actually went a little bit higher than that double top. But if we actually look at the spot price, it's a little cleaner. You can see it's almost perfectly went to the double top and now being rejected. Similar kind of situation for gold, a much more powerful uptrend In silver, though, it went way above the fibs. Actually, let me change the color on that. Sorry, just bear with me here. I'll just put it on a different colored Fibonacci. But again, you can pretty clearly see this uptrend. Similar kind of situation. The pullback hasn't been as aggressive as gold. So silver is showing a bit more resistance and resilience, I should say, than gold here. But just keep an eye on these sort of fib levels here. You can measure it either from down here, the 28th of October, or if you want, maybe on the 5th of November. But essentially, again, the silver bulls, they have to kind of, if it does continue to fall to fall more, they have to pick it up in these zones here. Although we should note that from a technical perspective, silver at this point, it's just been a double top rejection. It's not really a final rejection because at this point, as you can see, it hasn't even got to the 38% pullback from this most recent impulse. So at this point, we can say, a little bit of profit taking, no problem. But let's keep an eye on this silver chart. Okay, guys, I'm going to keep it there. No particular data coming up today. We still have lack of data, even though the US government seems to be sort of gearing up to reopen. So let's just see what happens with the equities. And as I say, within the equity space, keep a pretty sharp lookout between what's happening between all the different sectors and the riskier parts of the market. Thanks very much. Have a great day. Have a great weekend. And we will continue this next week. Thank you very much.